Hey warriors, welcome back to the next part of the CA final series. Today we are discussing something very critical. Today we'll be discussing on the case laws, or as we call the judicial updates, which ICA has launched specifically for your Jan 2026 examinations. Now, I remember telling this in the class, so I'm repeating this once again. Your significant select case laws, which is already part of your ICA study material, is already discussed during the classes. We have about 150 case laws which we have discussed in the classes. But those case laws are not extremely important to the sense that they're not tested very specifically in an exam format. Yes, they are tested. Like if it's a computation related case law, they will be part of a compulsory question as such. But they are not that more weightage kind of a case laws as compared to what ICA releases for your judicial updates. These judicial updates which ICA releases becomes extremely important because they can be tested in two scenarios. Scenario number one, if it's a computational adjustment, then we can expect this as a part of your question number one, your compulsory question. And scenario number two, if not, you can have it as a part of question number 5. The case law related question which comes as question number 5 can have this question of. Now, normally, yes, my suggestion is always that you are skipping off question number 5, no doubts about it. And so case laws to that extent may not be very significant and important for you. But it may sometimes happen, people, that out of 6 questions, you may be having a worry that yes, you know what, some other question looks extremely difficult to answer off. That's a question you're not even able to touch. In that scenario, maybe trying question number 5, at least the part number 1. You're definitely not going to be able to answer the BEPS and the MTC and other stuff. But at least the part number 1, if you're able to tackle it a little bit, maybe losing 14 marks versus at least gaining another 4 marks is a bonus for you. Yes. So to that extent, I always recommend that if it's hardly some 5 or 6 case laws, let's take an effort. Let's take an effort to understand these 5 or 6 case laws. You never know which one can help you for your exam purposes, and therefore, I want everyone's attention on this case laws. Now, if I have to clarify this a little bit, these significant case laws are basically coming up not just from your Jan 26 examinations. This has almost about, if I read this carefully, you have about 8 case laws giving to you. In this 8 case laws, 5 of those were already notified for September examinations. 3 is what additionally has been added for January examinations, which means 5 is what you probably would have already seen in the September judicial updates, and 3 is what you're going to extra read for your judicial update for Jan 2026. Now, the 3 case laws which really got notified this time are extremely nice and extremely good, which means they have more expectancy to come. But reading all the 8 case laws is always better, because in May 25 and September 25, it's not like all the 8 case laws got tested. Yes, so you need to pay attention to every case law and see which one is making more sense to you. Sorry. At every stage, what I'll do is when I read a case law for you, I'll also give you the respective chapter number, so that when you're reading this along with me, rather than sitting and focusing on the complete case law together, what we can do is we can prepare a small template in your book itself. You can go to that respective chapter, and wherever you feel that the section looks more relevant, next to that section you can put a small sticky note and you can put this case law there itself, so that during your day of exams you don't need to refer 2 different materials. Reading this itself along with that will automatically help you off. So what we're going to do, people, is we're going to read the case law, understand the case law, and then prepare a one-liner so that you can use it for your examination purposes. Are we clear? Ready to go? Amazing. Let's start with that understanding. First significant case law for you. First case law is from PCIT and another versus Jupiter Capital Private Limited, 2025 case law, Supreme Court judgment for you. Yes, this case law is something which we have discussed in September batch judicial updates as well, people. I'm just repeating it once again for you. The case law basically comes and says whether the reduction in share capital by a company without changing any shareholding pattern and face value of the shares will constitute a transfer under section 47 in the case of shareholders. So the question was very simple, which was raised by the authorities. The question was that when you do a reduction of share capital, can you treat it as a capital gains? Because if you understand this carefully, reduction of share capital is already part of deemed dividend concept. But the funny thing what happens is deemed dividend only gets invoked when you have accumulated profits. So the question which then came up before the authorities is when you do not have accumulated profits, or when the accumulated profit is less than the amount which you have received, can the differential be taken up to capital gains chapter of? Yes, that is what the question is. Let's read the facts of the case. The facts of the case say the associate company has held 15 crore 33 lakh 40,900 shares, which is giving him about 99.88% of the total shares. The company has incurred losses as a result of which the net worth got eroded. Like I said, accumulated profits are nil. On a petition filed by the company, the High Court ordered a reduction in share capital from 15 crores to 10,000 shares. So a massive reduction happened from 15 crores to 10,000 shares. Consequently, the shareholding of the person was also reduced from 15 crore 33 lakhs to 9,988. However, the face value of the shares has remained at 10 rupees even after the reduction in share capital. The face value was always the same, it's just that the shares have come down. The High Court also directed the company to pay 3 crores to the company. So the company has now received 3 crore rupees for the reduction of share capital which has taken place. The assessee has claimed long-term capital loss accrued on the reduction in share capital. Assessee went ahead and he came and said, because the company does not have any accumulated profits, to that extent, I am anyway going to treat this as a not taxable under dividend. But I have only received 3 crores vis-a-vis the number of 15 crores worth of shares which I had. And therefore, to that extent, I do need a long-term capital loss in my books. However, the assessing officer disallowed the assessee's contention for capital loss, agreeing that there is no transfer taking place. Assessing officer said 247 condition is not satisfied. I do not regard this as a capital case. The tribunal reversed the order passed by the High Court, and CITA also affirmed the order by the tribunal, which means technically the case was won by the assessee until the High Court level. Yes, this case on went to Supreme Court. Let's see what the Supreme Court says. Supreme Court here comes and says, the Apex Court has observed that the expression extinguishment of any right is of wide import. I have a very huge import on this. It covers every possible transaction that results in destruction, annihilation, extinction, termination, cessation or cancellation by satisfaction or otherwise of all or any bundle of rights which is qualitative or quantitative, which the assessee has in a capital asset, whether such asset is corporeal or incorporeal. They've given you some English people. Basically, they try to understand that when it comes to extinguishment, you can talk about anything. Yes, the more important part is here. In the present case, the face value of the share has remained the same before the reduction of share capital and after the reduction of share capital. Yes, however, the total number of shares has reduced from 15 crores to 10,000 rupees, out of which assessee holding 15 crores 33 to 9,988. It can be said that on account of reduction of share capital, the assessee has extinguished his right in this shares of 15 crore 33 and therefore receiving an amount of 3 crore 17 lakhs. The Supreme Court in the case of Karthikeya vs. Sarabhai observed that reduction of share capital, yes, would amount to transfer. So another case law was referred where another case law itself came and clarified that reduction of share capital is a transfer. Sale is only one of the modes of the transfer envisaged. Relinquishment of rights in which it may or may not amount to sale can also be considered as a transfer, and any profits or gains arising should also be taken to section 45. Accordingly, the High Court held that the reduction of share capital has resulted in transfer under the provisions of Income Tax Act, as there is an extinguishment of rights. The capital loss arising from proportionate reduction is admissible even if the overall shareholding structure of the company remains unchanged. Yes, so this is what the conclusion is of the case law. Now, if I have to drop a small summary, people, I would like you all to quickly go to the dividends chapter. And you'll find deemed dividend provisions there. In the deemed dividend provisions where you learned for reduction of share capital, put a small sticky note, people, and the sticky note will read like this. What is the case law name? The case law is going to say PCIT and other versus Jupiter Capital. Yes, you can say PCIT and another versus Jupiter Capital. People, I hope you're writing it along with me. Please don't waste time. Let's write it along with me. Good writing practice for you also, people. Yes, don't skip the video. Please write it along with me. What are we going to say? We're going to say reduction of share capital amounts to transfer. Reduction of share capital amounts to transfer as it results in extinguishment of rights. As it results in extinguishment of right, even if there is no change in face value or shareholding. Even if there is no change in face value or shareholding. Yes, this is a small note you're going to write down, people. Writing this much note is already going to be enough for your examinations. So let's write only this much and you should be done for your reading purposes. Yes, please make sure you put it in your deemed dividend concept so that it's easier for you to understand of. Are we making sense? Ready to go, people? Yes? Amazing. Let's read the next one. It says DCIT versus Travel Engineer India Private Limited. I have a company called Travel Engineer India Private Limited. What does this case law come and say? Again, people, coming from Supreme Court, the case law says whether for the purpose of computing limitation period under section 143(2), the relevant date is the date of filing the original return or the date of removal of defects in the response to notice under section 139(9). This is what the question is. Yes, now this is a weird facts question, people. The funny thing what happened is, let me explain this to you. For those who understand this, people, when it comes to section 143(2), 143(2) basically comes and says that you need to issue the notice for passing an assessment, for making an assessment within 3 months from the end of the year in which the return is filed. Yes, so you have time limit of within 3 years from the end of the month in which the return is filed. However, subsequently there is also a concept called defective notice. Defective notice basically comes and says that if you have made mistakes in the return, then you technically will be given a notice by the department, and based on the notice you will have to find a revised return. Yes, it won't be exactly like a revised return, you're simply trying to rectify your defects. Now, the situation in this case law happened a little weirdly. What happened is, the person had filed a return and the return was not valid because it was defective in that nature. Assessing officer had issued a notice to him, and because of the notice, the assessee ended up filing this return in the next financial year. And so what assessing officer did is, assessing officer went ahead and he passed the he gave the notice of 143(2) in the next financial year, the financial year after this financial year, saying that if you file the return only in this financial year, ending of the year plus 3 months makes me next financial year. However, the assessee came and said, sir, you have to take into consideration my original return. You cannot take into consideration my defective return. That makes no sense. Defective return is only for me to take care of my changes. It doesn't mean that the return itself was filed on that date. Return in all practical sense was filed by me right now, which means you have to take my original return into consideration for the purpose of computing 143(2). That's the facts of this case. We're going to keep it to that extent, people, and we're going to understand what exactly is happening here. Read. It says the assessee has filed his return of income under section 139(1) for 29th November 2023. Person has filed a return of income. The return was found to be defective, and accordingly a notice was issued on 10th July 24. Notice this carefully. The return was filed in this financial year, but the notice was given in the next financial year to correct the defects within a period of 15 days. The defects were then rectified on 15th November 24, which is the next financial year. Subsequently, the assessing officer issued a notice under 143(2) on 11th June 2025. Next financial year. He said, boss, you have only filed the defective return in this financial year, so I will give the notice in the next financial year, because it is 3 months from the end of the financial year in which you filed your return of income. However, the assessee contended that 143(2) can be issued within 3 months from the end of the financial year in which the return is furnished, which in my case would be the original return. Thus, the said notice was barred by limitation as per the provisions of the Act. So the assessee said, sir, 143(2) is invalid. I am not proceeding with the assessment. I don't want to give you any kind of facts and information. Let's see what the answer is. Section 139(1) requires a filing of return by the assessee, while section 139(9) requires an opportunity to rectify defects in the return without filing a fresh return. So 139(1) gives you the opportunity to file return. 139(9) simply says you can file a defective return response for the defects you have. 143(2) requires the assessing officer to issue a scrutiny assessment within 3 months from the end of the financial year in which the return was filed off. And such notice is a prerequisite for you to open up your assessment under 143(3). Since the return was defective, the assessee was called upon to remove such defects, which was removed on 19th July, which is within the time limit allowed by the assessing officer. So the defective response was made valid, return is valid. Therefore, upon such defects being removed, the return would relate back to the date of filing the original return. This is the most important line. This line basically comes and says that the moment you have filed the defective response and the return has become valid, it is not that the new return has become valid, it is that the original return itself has become valid, which means the original return is what you will take into consideration and not you filing a defective response return. Consequently, the limitation of periods would be the 30th June 2024, within 3 months from the end of the financial year in which the original return was filed. In the present case, the notice under section 143(2) was issued on 11th June 25, which is much beyond the period of filing a limitation, and hence this notice is barred by limitation and cannot be sustained off. This is what the facts is. Yes, a very nice case law, people, but honestly speaking, good case law for you to test. Now, this case law, if it has to be tested, will be tested as a part of question number 5. Yes, question number 5 is what this case law can come in. They can give you something similar with name changes and they will ask you what the facts of the case is. Please go back to your material, people. You will go back to a topic called as assessment procedures. In assessment procedures, you're going to go to a section called as section 143.2 and you're going to write this thing for me. Yes, so 143.2 is what we're reading of, people. Let's read 143.2 and write a response accordingly. The response of 143.2, we are going to write as DCIT versus travel designer. We're going to write it as DCIT versus travel designer. What is the case law going to come and say? Where defective notice is responded, where a defective notice is responded and the mistakes are rectified, where the defective notice is responded and the mistakes are rectified, the original return filed would be considered the valid one. Would be considered as the valid one. Hence, 143.2 needs to be issued considering the original ROI and not the defective response. Considering the original ROI and not the defective response. This is what the facts of the case would look like. This is what the facts of the case would look like. Yes, yes, yes. I'm really hoping, people, that the small notes which I'm giving to you is going to be helpful for your examinations, rather than you sitting and writing so much of theory, rather than reading so much of content. If you can just understand this much, you're already through with the thing. And I'm trying to make sure that you're writing this notes next to the specific provision you're reading for your examinations, so that it's easier for you to link it off rather than reading this much of paragraph stories. Yes, amazing. Let's go forward. Question of Bank of Rajasthan. Bank of Rajasthan versus CIT 2024 Supreme Court judgment. Whether the interest paid by the bank for a broken period on purchase of securities can be claimed as revenue expenditure. This is what the facts of the case is. Now, the case was a little particular, people. This is a more banking industry related case law. Issue basically what happens is, when a bank goes and buys some securities from another person, obviously the bank is going to buy it at some random date. Yes. Now, the person who's giving the securities to you normally would not going to sell it to you for the market price. If you understand this carefully, when a person has bought a security, he is eligible for some interest on this. Agreed? And so what happens, people, is that he is now eligible for some interest, and that interest would have been for a specific period. A simple example, if I have to give you, imagine that there is a debt which has been bought by a person, and the debt comes and says that you will be eligible for receiving interest every 6 months. Starting from April. So after April, the next period which he'll get is for May, June, July, August, September. So September is then the last time, October is when he's going to receive the 6 months worth of interest. Now, if I go and approach a person in the month of June and I tell him I want to buy the security from you, obviously this person would come and say that I'm ready to sell it to you for the market price of June. But at the same time, the interest which I am supposed to receive for the month of April to June is something you will have to give me back. Logically valid? Yes. And so this is what the case happened. The bank went to a person and said, I want to take some securities from you. The person said, I will give this security to you at the market price, plus you also have to reimburse the interest which I am supposed to receive for the last few months which I was holding this asset for. The bank said, perfectly valid, have it go. Now, when the bank ended up making the payment, bank took the payment and split them into two. He said the market price is what is my cost of acquisition, but the interest which I'm paying to him because of the broken period, that interest is something which I should claim as an expenditure. However, here is where assessing officer came up and said, how is that valid? When you're going and making the payment to a person, you're paying the complete sum to him. So your cost of acquisition should be the complete sum, including the broken period interest. How can you come and defend saying that the broken period interest is your revenue expenditure? That is the facts of the case. Are we making sense? Perfect. Let's read it to that extent and then now see if you understand the facts. The facts are as follows. In the present case, an assessee, which is a scheduled bank, has involved in the purchase and sale of government securities. So the person goes and buys some government securities. It is classified that these securities are held as stock in trade in the books of accounts. So the person is holding this asset as a stock in trade, meaning he's buying it with an intention to sell. The assessee consistently follows the method of setting off and netting the amount of interest paid by it on purchase of securities, which means when I make the payment, I will treat it as a revenue expenditure. Similarly, when I am selling the security to someone else, I will also go and recover the interest which I am eligible for. So that is also what I am going to offer as income. So I am following a consistent practice that when I sell it to someone, whatever money extra I get, I recover it as income. And whenever I pay someone for the securities, whatever money I have to pay to him for the broken period, I treat it as an expense against the interest recovered by him on sale on securities and offering the net interest to tax. The method was accepted in the earlier assessment. See this carefully. What has happened is in the prior years and all, assessing officer said there is no problem. It is now that the assessing officer comes and says, no, I don't accept it. However, the Commissioner of Income Tax has exercised this revisional jurisdiction. So now assessing officers were fine with this. But now the CIT comes forward and CIT comes and says, I don't agree to this. I'm going to issue a revisional order under section 263. So CIT is now coming and taking the overcharge on this, holding that the broken period interest forms part of the cost of acquisition and is not allowed as deduction. So the CIT now comes and says, the CIT comes and says, I do not accept this fact. You should have treated it as cost of acquisition, no claiming it as an expenditure in your P&L. The Apex Court, the Supreme Court, has now come and said that the banks are required to purchase government securities to maintain their statutory liquidity ratio. So I'm buying the securities for the purpose of RBI guidelines. As per RBI guidelines, these are of three categories. One is what we call as HTM, held to maturity, AFS, available for sale, and HFT, held for trading. Now, held for maturity means I'm going to buy this, I'm going to keep it with myself, which means this is an investment accounting. Available for sale is basically when I'm having an asset and I'm planning to sell it off in the market. This is not going to be called as an investment accounting. This is rather going to be called as a stock in trade. And the same thing is called held for trading. Held for trading is also where I'm going to buy the security and use it for the trading purposes, which means purely stock in trade. As far as AFS and HFT are concerned, banks held such assets as stock in trade. See, when it comes to AFS, available for sale and held for trading, it is always treated as a stock in trade. Therefore, in these two categories, the benefit of deduction should be granted for the broken period. The benefit of deduction should be granted for the broken period. It is only that the securities of HTM are held for a longer time till maturity. If it was found that the HTM security is held as investment, the benefit of the broken period would have not been available. So here is where Supreme Court came and said the answer to this question will be decided based on what is your intention of the asset. Are you going to hold it as an investment? If yes, then yes, it has to be part of cost of acquisition. But if you're already following the practice to treat it as a stock in trade, and whatever expenses you have, you're claiming it as expense, whatever incomes you have, you're offering as income, then I don't see a problem in this accounting system. The accounting perfectly looks valid. Accordingly, the Apex Court held that where the securities are treated as stock in trade, the interest of the broken period cannot be considered as a capital expenditure and have to be treated as a revenue expenditure to be allowed as deduction. Yes. Now, what is a broken period is what they have clarified to you people. I think we have already understood what is a broken period interest. So this is what the facts are. I hope these facts are making very sense to you. Yes, let's write down this. Now, where are we going to write this down, people? We're going to write this down in your basics of income tax. In your basics of income tax chapter number 1, where we discussed about what is called as revenue receipts and capital receipts. That is the space where you have to write this notes down. So go to your revenue receipt, capital receipt provision, and there we write this understanding of. Yes, so my case law is called Bank of Rajasthan. Bank of Rajasthan versus CIT. Bank of Rajasthan versus CIT. What does the case law come and say, people? Where any securities are held as AFS. People, I hope you understand the full form of AFS, available for sale, and HFT, held for trading. Any interest paid for the broken period is treated as revenue expenditure. is treated as revenue expenditure. People, this is an additional line which I'm adding it up to you so that you understand this better. There is sometimes ICA may play you a game also, so let's be careful of it. I'm writing it as where asset was held for maturity, HFM, held for maturity, interest would be capitalized. Interest would be capitalized. The next part of the thing is not part of the case law, people, but it's somewhere given as a reference point in the case law. So therefore, it's important you read this part also. Yes, sometimes what happens, no, people, ICAI is also smart enough. ICAI would come and say, yes, students are mugging up the whole case law. Therefore, they're only reading the fact that it's revenue expenditure or not. And suddenly they'll come and ask you a question where it will not be HFS, HFT or AFS, but rather they'll give you a question where it is HTM. When it is HTM, please be careful. It is not going to be treated as a revenue expenditure. It is going to be treated as a capital expenditure. So read the lines very, very carefully before you make a conclusion on the adjustment of. Clear? Yes, this goes to chapter number 1, people, revenue receipt and capital receipt. Now, I don't expect this to be part of computational question because this is a very specific bank related adjustment. So therefore, I expect this more as a part of question number 5. But my gut feeling from question number 5, people, is always relating to assessment procedure case laws. They don't generally test you on these kind of case laws. So expectation of this case law to be coming up in exam is close to zero, but nevertheless, a very easy case law should not be held rocket science. You should be able to read it in a second also and close it off for your exams. Yes, yes, perfect. We are at 4th case law. Case law number 4. It says PCIT versus Adadin Technologies Private Limited. Now, something similar of this case law is already there in your material, people. They're just adding it further to you because it's the latest case law from a Supreme Court judgment. Case law is like this. It says where the expenses incurred by the assessee towards the development of software for advertisement, which due to technological development has been abandoned, can it be claimed as a revenue expenditure? So the question which has come up before courts is, I was planning to make a software. Unfortunately, what happened is when I was making the software, the technology became so rapidly changing that the software was obsolete anymore, which means I did not want to proceed forward with the software development itself. Midway through the project, I decided I would like to abandon it. Whatever expenses I incurred for this project is what I've now treated as revenue expenditure. Here is where assessing officer comes and says, boss, at any point of time, this was a software development expenses, which means had the project been gone forward, you would have treated it as a capex expense. How that just because your project has been abandoned, you can claim it as a revenue expenditure is what the fact says. Now, this case law can actually take reliance from 2 different other case laws also, people. One is called PVR, Privilege Roadshow case law, which is there in your study material, and something called McGraw Laboratories, which is not part of your study material as a part of significant case laws, but something which ICAI tests you in so many exams, including the September examination and May examination. McGraw Laboratories, for some reason, is one of the most favorite case laws of ICAI. Now, this case law is not completely related to it, but it's fairly matching with that case law. Let me first explain these facts and then I link it with that case law also. First, it says the assessee is the company engaged in the business of rendering customized internet advertising services to advertisers which could be used for desktops. I'm into advertisement services. In order to develop its software, assessee had incurred certain expenditure. However, due to rapid changes in technology, the applicant sought to be developed has become obsolete, and the assessee has abandoned further development. So I had found it obsolete and therefore I decided to make it as obsolete for further development. I did not want to proceed forward. Decision. The High Court held that since the product has been abandoned, the assessee has not got any enduring benefit. He will not get any enduring benefit. In substance, the assessee has incurred expenditure in these 2 years to develop a software, but due to change in technology, it has to abandon the project. In effect, it has lost money spent on the product. Accordingly, the High Court held that assessee shall not get any enduring benefit, and therefore the expenditure was to be treated as revenue in nature. Yes, so this is what the facts of the case is. Basically, the courts have come and said, boss, when you're already incurring money, losing money here, not getting any enduring benefit, why should I treat this as a capital expenditure? You might as well claim it as a reduction as revenue expenditure. I have no objections here. That is what the case law comes and says. Now, let me link this to PVR and McGraw. Privilege Roadshow also had the same judgment. Privilege Roadshow basically came and said that when I was starting a new project, and I had incurred the expenses, but later on the project was not fruitful for me, so I decided to abandon the project. Whatever expenses I incurred for that project will be treated as a revenue expenditure. However, on the contrary, the same facts in McGraw Laboratories come and say that when you have taken up a project for a new business, in that case, whatever expenditure you've incurred will be fully treated as a capital expenditure, because here is when you're trying to venture into a new business altogether. The moment you decide to venture into a new business, the current business has nothing to do with the new business, and therefore whatever expenditure you incurred there cannot be claimed as an expenditure, will be treated as a capex cost without any depreciation because no asset came into picture. So now if you understand this with other than people, in other than case law also, what technically happening is that I am not making a new software for a new business. I already am running a business in which I have done a software development, which means this case law has more linkage to Priya Village Roadshows. So now you need to read it like this. When I'm looking at Priya Village Roadshow is about new project in the existing business, revenue expenditure. Adadin says new development in the existing business allowed as an expenditure. McGraw Laboratory says new project in new business, capital expenditure. That is what the hint will be for you. Yes, so if I have to put it out as a summary for you people, the summary will be like this. If I tell you that there is an abandonment, you're going to ask me, Rahul, what is this abandonment for? I say it is abandonment of a project for existing business. Project for existing business. In that case, I will say revenue, because here is where Priya Village Roadshow comes into picture. Next, if I say this is a project for new business, then I will say capital, because McGraw comes into picture. On the contrary, if I say that I am going to make a software for existing business, this will become a revenue expenditure, because here is where Adadin comes into picture. This is what the summary would be. Yes, for this one people, I would rather not focus on putting some English out people, because this is an adjustment which will be part of your compulsory question number 1. Compulsory question number 1, like, you'll have an adjustment something similar to this. So you just have to figure out one of the 3, and you can simply say revenue expenditure or capital expenditure. If it is there in P&L, allowed, ignored. If it is not there in P&L, then I will treat it as an allowable expense. But if it's a capital expenditure of McGraw, then if it is there in P&L, I will disallow it as an expense. This summary should already be doing enough for you. You don't need to focus more attention on anything else. Yes, so this is a summary for the Adadin case law. Are we clear on this part? Yes, amazing. That brings me to last 4 case laws, people. Case law number 1. Case law number 1 comes and says that I have Johnson Matthey Public Limited versus international taxation for CIT. Now this is more relating to your international taxation, and we'll need a little bit of an understanding of your treaty rules. But before that, let's understand this. It says whether the amount received for guarantee fees, I'm going to receive an amount for guarantee fees by a foreign company from its Indian subsidiaries, would fall within the definition of interest. Here is a case where basically what has happened is Indian company has taken a loan. To guarantee this loan, the foreign holding company has come and given a guarantee. Because the foreign holding company is giving a guarantee, foreign holding company, as per transfer pricing rules, is eligible to claim something called as guarantee commission from the Indian company. Now the Indian company ended up paying this guarantee commission, and here is where foreign company used to come and say this is another income clause and therefore not taxable. The assessing officer did not have an option. He went on to the treaty and he came and said guarantee fees according to me is nothing but interest. Had you taken the loan from someone, had you not taken the loan from a bank but rather taken it from your holding company itself, it would have been as good as you calling it as an interest, and therefore I would like to classify this as interest and ask you to pay tax of it in India. That is what the facts is. Now the foreign company came and said, sir, how can a guarantee commission be tantamounting to interest? Interest is a very different concept. There should be a debt involved to have an interest. Here is me only trying to save myself from a future risk, and therefore it cannot be an interest here. I don't accept this fact. I would like to treat this as another income clause, treat it as exempt. And so the case has now went on to Delhi High Court, and the Delhi High Court has made a judgment on this. Let's see what the case law looks like. The case law basically came and said the assessee was a tax resident of UK, foreign company, and engaged in the manufacturing specialty of chemicals. So there is a manufacturing specialty happening. It has entered into a global corporate guarantee for the purpose of securing loans taken by its Indian subsidiaries from foreign banks. So if an Indian subsidiary ends up taking a loan, then this person is responsible for giving guarantee on this, and accordingly charges guarantee commission for excluding such guarantee. This is what is going to happen. Yes, now let's look at the facts. Let's see what is happening. As per section 228A, an interest means an interest payable in any manner in respect of monies borrowed or debts incurred. So interest would only mean monies borrowed or debts incurred, including a deposit claim or other similar rights. It also includes any service fee or other charges in respect of monies borrowed or debts incurred. Article 12(5) of India UK DTAA defines interest to mean any interest from debt claims, whether or not secured by mortgage, whether or not carrying on any right to participate in debt as profit, and in particular income from government securities, income from bonds, income from debentures, including premium and prices attaching to such securities, bonds or debentures, but subject to the provisions of paragraph 9 of article, which not includes any item treated as distribution of dividends. So this is what a generic definition of article 12(5) says. Absolutely not important for you to understand, people. Let's focus on the analysis of the case. Analysis of the case says the High Court has concurred with the view of the tribunal that the word interest as defined in article 12(5) along with section 228A should be understood contextually. Article 12(5) and section 228A extends the scope of such payments. However, payments or repayments pursuant to any loan is what is qualified as interest. Necessarily have to be in the context of a loan and shall relate to parties to the privity of the contract. I can only treat this as an interest when it is relating to a loan. In this context only, the expression claims of any kind, service fee or other charges would have to be understood. The word interest does not take into fold any payment made to stranger of the privity of the loan transaction, though such payment may be related to the loan. It very clearly comes and says that when it comes to interest, interest is only talking about those kind of payments which are going to make to the person giving you the loan. If I am a third person giving you some kind of guarantee and all, I am not party to the discussion of this loan. I am a third party here. And to the extent of the third party, payments being made to him has nothing to do with my loan computation. Undoubtedly, the assessee is a stranger to the privity of the loan transaction in as much as the contract of the loan is different from the contract of guarantee. And as such, in our considered opinion, the expression of the debt claims of any kind or the service fee or any other charge does not stand extended to the payment of guarantee commission which is received by the assessee in India. So it will not have any kind of bearing on the guarantee commission which is paid up in India. The expression interest is defined to mean amounts payable in respect of any monies borrowed. Undisputedly, the appellant has not borrowed any monies from the assessee. The debt, if any, which could be said to have been incurred was clearly not the one owed to the Indian subsidiaries. There is no kind of debt happening to Indian subsidiaries. It is between Indian subsidiaries and the bank. The income that is received was solely in consideration for any liability that could possibly befall in case its Indian subsidiary were to default in the payments. My responsibility only comes when someone makes a mistake. Accordingly, the High Court held that the guarantee fees would not fall within the definition of Article 12 of DTAA or Section 228A of the Income Tax Act. That is what the provisions came and clarified. Yes, so a very beautiful case law, people, which basically comes and says that when it comes to guarantee commission is not an interest because it has nothing to do with the loan transaction. I'm only acting as a third party here, sponsoring the kind of loan in case there is any default happening in the future events. Yes, so that is what is the answer of this question. Clear? Yes. What is the case law going to be noted down for? People, please write this case law in your international taxation, non-resident taxation chapter is where you're going to write this case law for. Yes. So I'm going to take this case law down. Let's take this case law down, people. Please go to your international taxation. It's going to be called Johnson. Is it double T? Yes. Johnson Matthey. Weird names becomes weird issue. Johnson Matthey Public Limited. Johnson Matthey Public Limited. What does the case law come and say, people? Any guarantee commission received would not be considered any guarantee commission received would not be considered as interest, would not be considered as interest, as interest refers to only payments made against a debt. As interest refers to only payments made against a debt. A guarantor is not party to the loan transaction. A guarantor is not party to the loan transaction and only gets involved when there is a default from the lender, and only gets involved when there is a default from the lender. That is what the case law is. That is what the case law is. Yes, yes. So this is the case law for you. I hope this is making sense to you. Yes, amazing. With that, people, we are moving on to for next 3 case laws. Now, next 3 case laws has come up for specific Jan 2026 examinations, and trust me, this is one of the most beautiful case laws because this is a pertinent issue going on in the market right now. Huge concerns are going on in the market right now. So therefore, this case laws are really expected to be tested in exam. Focus attention. Case law of IBS softwares. This case law basically comes and asks whether the assessing officer is bound to pass an assessment order within 1 month from the end of the month in which the directions of the DRP is issued. Basically, what happens now, people, is that when you go to DRP guidelines basically come and say that when you filed a reference before DRP and the DRP passes a direction on this, the assessing officer has to take this into consideration and pass an assessment order, final assessment order, within 1 month from the end of the month in which the direction is issued. Here is a case where basically what happened is in IBS softwares, the assessing officer delayed these directions. He did not end up passing the final assessment order on time, and therefore the assessee went to the income tax department and said, the order which you have passed is time barred. I do not see the validity of the order, therefore I would not accept any kind of disallowance which has taken up here. On the contrary, the assessing officer came up and said, boss, at the end of the day, the DRP is simply giving me a direction. In any stage, if you understand this carefully, assessing officer has no powers to do anything with it. If the DRP has come and told me this is what has to be done, then you also know and I also know that we are going to do this only. Me passing the order within time limit or not should not affect the outcome of the case. The outcome of the case would have remained the same. Had it been a story where I had to sit and I had to verify some facts or I had to do some other analysis, then yes, I accept your contentions. But when the DRP has come and told me that this is what has to be done, then whether I give you the order on time or not, it should not really matter to you because you already knew the outcome of the case. In that scenario, for me, the 1 month timeline which is given is more of a recommendatory timeline and should not be treated as a mandate. That is what the assessing officer came and contended. However, here is where the assessee said, sir, who are you to decide whether this is a mandatory timeline or this is a recommendatory timeline? When the provisions clearly come and say that you have to pass the order within 1 month, it becomes a mandate on your head to come and do that accordingly. With you not passing it on timeline, don't give me excuses to come and justify on why the DRP looks like. A law, if it is given with a timeline, is supposed to be adhered by you, and since you have not adhered it, I do not accept the validity of this assessment order. I would like this to be treated as void. This is the fight which went on to the courts, people. Now, this fight unfortunately has unfolded so significantly enough that every courts have made their own judgments. A few courts accepted and said, yes, the assessee is right and this should be time barred. The other courts came and said the officer is right because technically the assessee had nothing to do with the order of. He already knew the answer to this case of. Yes, so to that extent, things were very, very ugly when it came to the court. One of the case laws has been notified by ICI in your syllabus. Now, should I be focusing only on this case law from a practical standpoint? No. People on a practical level things are going very difficult, but yes, on an academical level, from an exam perspective, only this case law is notified to you. So for an exam, you're only going to read this case law and let's see what the outcome is. Facts of the case. The assessee has filed a writ petition challenging the assessment order issued by the competent authority, mainly on the grounds that they were issued beyond the time limit which was specified under section 144C13. So they filed a writ petition and they said, sir, the order is invalid. The department then contended that a breach of time limit under 144C cannot be considered as a vitiating factor affecting the very validity of the assessment. So the officer comes and says, sir, me passing the order late should not affect the outcome of the case. It was further submitted that the assessing officer is not vested with any discretion under 144C when the DRP has issued direction. When I know I cannot do anything about it, DRP has told me that this is what I have to do, then that is what I would have done. There is no reason for me to come and object it otherwise. So what is the point of you coming and questioning me on this kind of activities is what the question said. The department contended that even if the assessing officer takes more time than it is provided, no prejudice is caused and the assessment needs not be considered as vitiated. Yes, how does it matter whether I take more time or not? At the end of the day, the outcome would have remained the same whether I passed it on time or I passed it late. So you should not be taking that as a defense point is what the department came and contended. The High Court held that 144C was incorporated by an amendment. The amendments are thoughtful, purpose-driven changes made to an existing legislation by the legislature. If I'm making an amendment, it is obvious that I want to do it because of a thoughtful intention. When an amendment is made, it must be assumed that the legislature felt it was appropriate to alter the laws as it existed prior. When someone makes an amendment, it is only because of the fact that they thought that this is more critical for you to keep in mind. Section 144C was incorporated with an objective of providing a speedy mechanism for assessments involving transfer pricing matters. The whole intention of doing DRP itself was that you want to get an outcome very, very fast to reduce the possibility of disputes and to avoid the time-consuming litigations. The High Court thus concluded that the assessing officer is bound to adhere to the time limit which is given under section 144C and the assessment order issued is in breach of it shall be invalid and was accordingly set aside. So this is the case law where High Court has come and said if an amendment was brought, you should have followed the amendment. Obviously, at the same time, the DRP whole intention itself was to make the process speedier. So you taking your sweet time on this does not make any sense. I will not accept this. You should have followed the 1 month timeline. Because you did not follow the 1 month timeline, I will treat this order as invalid. Is what the contention is. Yes, a very beautiful case law, people. Now, if you come and ask me question number 5, yes, a very, very critical case law from question number 5 perspective. Expect a question on this in exam for question number 5. I do hope that they ask this question because yes, in the market, it's a very pertinent issue going on right now. So go forward. IBS software services. IBS software services, the case law basically comes and says the time limit given in section 144C to pass final assessment order is a mandatory rule. Is a mandatory provision introduced by an amendment. Is a mandatory provision introduced by an amendment. Hence, any order passed after this time limit, would be time barred and invalid. That is what the case law comes and clarifies. Yes. Good. Beautiful case law, people. You should be taking this into attention because yes, a pertinent issue going on in the market. Example question number 5 for your exams. Yes, question number 5 for your exams, expectation question. Please look at this very, very critically. Good. Last 2 case laws for me to discuss. First is on the Frontier Information Tech Limited versus TCIT. Now, this is the most controversial case law I have seen, and trust me, this is the case law which I expect you to get an exam this time, because I am very, very sure by the time Feb arrives, this would be overturned. Yes, budget law, they will make a change in the act and they will make a change for this, because this is more of an interpretational challenge which has taken place. So look at this case law very carefully, people. See what the case law looks like. Question. It says whether the conversion of interest due on loan into equity of the company amounts to actual payment of the interest and is to be allowed as deduction under section 43B, as per 43B. Now this is something which I've requested and asked you in the classes so many times. The issue was like this, people. Basically what is happening is, when I have an interest outstanding, I was not paying this interest on time, because of which all my interest was getting disallowed under section 43B. I was taking this interest and I was converting them into loans, debentures, debts, anything of those sorts, and I was treating this as a full payment of an interest. Now, courts, along with a circular notification and then a subsequent amendment also was introduced, where they came and clarified that simply by converting an interest into your loan, debt and all, you cannot come and treat this as a payment of interest and therefore treat it as an expenditure allowable under 43B. Only when you actually end up making the payment is when you will get this claim off. However, here is the case law where basically what has happened is, a person has taken the interest and has converted into equity component. Here is a case where I will not be in a position to make the payment of debt itself. Understand this carefully. For the other cases which we discussed, when you convert the interest into a loan, you still have an opportunity to pay the loan at a subsequent date. But when I convert this interest into equity, there was no opportunity for me to make the payment on a subsequent date, because equities are irredeemable. And therefore, this is a case which went on to the courts to come and ask that, sir, if I'm converted the interest into equity, why should I not be getting the claim when I made the conversion itself? For me, the moment I converted them into equity, it was as good as the payment has been made off. And therefore, you should distinguish this from the other circulars and notifications that you have passed off. That is the contention coming up here. Let's see who won the case. Facts of the case come and say, associate company of a developer of a software has converted an interest due of 75 lakhs to Andhra Pradesh Industrial Development Corporation, being a state industrial development corporation, and the interest of 39.94 lakhs into equity shares. So what has happened is, whatever is the interest which was outstanding, which I had not paid in the past, has now been converted into equity shares. The assessing officer held that the actual payment of the amount was sine qua non for allowing the deduction of 43B. Actual payment is the only condition based on which you can claim 43B. It was further held that conversion of outstanding interest into loan, funding of interest into equity does not amount to actual payment. This is what we were discussing, people. Simply by converting, you cannot call it as an actual payment. Accordingly, the assessing officer has disallowed the provisions of section 43B on the ground that no payment was actually made. No payment was actually made. Let's see the analysis. The analysis of the High Court came and said that the liability of the assessee to pay the interest ceased on the date of issue of shares. The moment the issue of shares was done, it was ceased off. You were not having an opportunity itself to make the payment anymore. The same was tantamounting to actual payment within the meaning of 43B. Therefore, the assessee is entitled to claim the deduction. The assessee is entitled to claim the deduction. Please do expect this question in exam. You already have read it in your materials on conversion of interest to loans not being allowed as deduction. Here is a case where I am converting the interest into equity and I have to give this as a deduction. Yes, so this is going to be very, very important for your compulsory question, people. For your compulsory question, please keep this in mind. Please keep this in mind, that when I talk about conversion of interest, when I talk about conversion of interest, I'm going to be answering it on two fronts. I'm going to be answering it on two fronts. Am I converting this interest into a debt? Am I converting this interest into a debt, or am I converting this interest into equity? Into equity. If I'm converting this into debt, it is not a payment, and therefore not allowed under 43B. It is not a payment and therefore not allowed under 43B. Whereas when it comes to equity, consider as payment. Consider as payment, allowed on conversion. allowed on conversion. That is what the case law says. Yes, so Frontier Information Tech Limited case law has come and confirmed it will be allowed as a deduction. Now trust me people, I do expect this to be amended off in the next year, which means this is going to be a mandatory case law for your examination purposes. So please focus on this case law very carefully. Yes, please focus on this case law very carefully. Clear with me? Yes, a very beautiful case law, people. So please pay attention to this case law for your exam purposes. It's going to be very important for your examinations. Clear with me? Are we ready to go? Yes, amazing. Let's move on forward to the last case law. The last case law, basically, people, is from CIT versus Jindal Tractable Power Company Limited, where they have talked about something very particular. Yes, look at this case law. The case law basically came and said that when a reliance has been placed on the professional advice, can this be treated as a reasonable cause for not deducting tax at source, and consequently penalty under section 271C is leviable for the failure to deduct the tax. Here is an interesting case, people, where you and I are being questioned. Basically what has happened is an assessee had not ended up paying any tax at source, and therefore the assessing officer had levied a penalty under 271C. The assessee went on to the tax officer and came and said, sir, I did not pay this tax because a CA came to me and came and said that this is not liable for TDS. I trusted his judgment because he is the expert on this matter, and therefore I did not deduct TDS. For me, this is already a reasonable cause for me to not be levied penalty. There was no intention to cheat here. I majorly relied on the professional advice of a CA, and therefore to that extent you should not be levying penalty on me. I am going to accept my assessee in default conditions. I am going to be ready to pay my interest also, but do not levy any penalty on me because it was not my mistake. I got a professional judgment on this. Can this be a line of defense for treating something as reasonable cause is the question which has come up. Let's see what the advice answer is. The assessee company had not affected TDS on the monies payable to a foreign entity under the contract relating to supply of services for an offshore equipment. So I was doing some offshore services, and for that I have not done any TDS. They did it on the professional advice that no tax was required to be deducted by way of TDS in so much as no income was deemed to accrue or arise in India. So the CA, whoever was taken up into responsibility, had come and confirmed saying that there is no income accruing or arising in India. Why do you want to deduct TDS? So therefore it is not required. The foreign entity has also applied for advance ruling seeking a final opinion in this regard, which was not processed. So the foreign company had also asked for a board of advance ruling condition on this, but unfortunately that was never processed off. The competent authority, meanwhile, has initiated penalty proceedings under section 271C for failure to deduct the tax and disregarded the explanation offered by the assessee that the non-deduction of tax was due to a bona fide belief formed on the basis of a professional advice. Despite the assessee coming and saying that, sir, I trusted a judgment of a professional here, I'm also waiting on a judgment of board of advance ruling, the assessing officer went ahead and he levied a penalty on 271C. The Commissioner of Income Tax agreed with the explanation offered by the assessee and granted a relief to it, observing that non-deduction was not tainted with the malefied intentions. There was a reasonable cause for non-deduction. CIT appeals itself came and said, I don't accept with what the assessing officer has done. I think this was not done with a malefied intention. The person was being genuine here because he relied on a professional advice. Therefore, it should not be treated as a penalty situation. The Honorable High Court went ahead and took this case up. The assessee in his reply specifically stated that non-deduction of the subject was due to a professional bona fide belief formed on the basis of a legal opinion of a law firm. Okay. My bad, people. This was not done by a CA. It was done by a law firm. So they went ahead to an advocate and they got this opinion of. Trust me, we are safe on this. Good. And okay, too early to judge. It was also done based on the opinion of a chartered accountant, like I said, people. So it was done by a chartered accountant firm along with a law advocate model of this. Apart, the foreign entity has also sought advance ruling, and the chairman of the advance ruling, now board of advance ruling, did not process the same for personal reasons. I had made an application for board also, but the board is not giving to me. I am not held responsible. Added, what benefit the assessee could derive by not deducting the tax is also a factor. There was no benefit which is coming up to me. Why should I be treating it as a default here? All these certainly constitute a reasonable cause for not affecting TDS, and therefore the impugned order, being consistent with the same, is not vulnerable for challenge as rightly contended by the assessee. It was held that non-deduction of TDS was not tainted with the malefied and reasonable cause was shown for non-deducting TDS, and therefore no penalty should be levied on this case of Yes, now this case law came in as a good relief for all the assessees who are getting advices from professionals, because in the past, whatever used to happen is when professionals used to give advices, we always used to put a disclaimer of, and we used to come and say, we are giving you advice based on what we understand. Tomorrow, if the officer says something otherwise, we are not going to be held responsible. But at no point of time were they taking ownership on the penalty part of it, which means assessees were still paying penalty despite the fact that they had got opinions of. This case law now acts as a relief that you can now go to a professional firm and you can get an advice, and as long as you have a document which proves your intention, you one can levy penalty on you. Yes, this will now open up opportunities for a lot of companies to take some very defensive positions in market and get an professional advice on it. That professional advice, which again on a defensive position, will now be treated as a reasonable cause enough for them to not get levied penalty. Yes, so this is what the case law is going to give. Now, where do I put this, people? Please go ahead and put this in section 271C, or if you feel like better, you can go to penalties chapter and also put it off. Yes, we have a section called 273 there. You can go and put it there also, but please put a sticky note accordingly. Yes, case law, final case law, people, note it down for me very quickly. It is CIT versus Jindal Tractbell Power Company Limited. Yes, Jindal Tractbell Power Company Limited. This case law basically comes and clarifies when a when a professional advice is received, when a professional advice is received for non-deduction of TDS, it would be considered as, when a professional advice is received for non-deduction of TDS, it would be considered as a reasonable cause. It would be considered as a reasonable cause, and thus no penalty can be levied. And thus no penalty can be levied. This is what the case law is. This is what the case law is. Yes, very beautiful, very beautiful. This is what the case law should look like. I hope this was understood for everyone. Yes, you're going to keep this case law accordingly and you're going to make a judgment on this. Now, people, where can I expect this case law? Again, same thing. Expect this case law more part of your question number 5. It cannot come as part of anything else. Yes, so question number 5 is what you can expect this case law on. In question number 5, they can ask you this case law also. So if I understand this carefully, people, out of 8 case laws, which one should be focused upon where? Let's look at it quickly before we close for this. I know I'm done at 1 hour, people, but I think you should be able to understand everything right now. Case law number 1, which was more about your extinguishment of right, is going to be part of your question number 5. Yes, actually, you can expect this as part of question number 1. You can expect this as a part of question number 1, people. In compulsory question number 1, you may get an adjustment which may come and say that there has been a reduction of share capital in the current year, because of which the person has made some losses. Can you treat it as capital loss? Is what the question can come. So expect this part of question number 1, compulsory question. Second, I have my assessment timelines of travel designer. This is part of question number 5. Next, I am going for Bank of Rajasthan. This is my expectation to not be tested. This is my expectation of not being tested. I don't know where they'll test you also on this, people. So yeah, then we have Adadin case law is part of question number 1, for sure. Question number 1, people, because this is now having 3 different opinions. Then we have your John Smathley. This is going to be part of your non-resident taxation question. This is going to be part of your non-resident taxation question. Where are we? Yes, this is on the DRP. DRP goes to question number 5. Your case law related question. And then finally, we are at the last 2. Conversion of interest is for sure part of question number 1. Expect a question on this, people. I'm really hoping they should test you on this, because it is going to change in the next year. So therefore, they have to make a swift move on this. Question number 1 is the expectation on this. And finally comes to your Jindal advices. This can be part of question number 5, or can be part of your TDS topic. You can expect it there also. Yes, which means these are some 8 case laws which you should be paying attention to, and trust me, it will be really helpful if you pay attention to them. Maybe the question number 5 related case laws, people, if you think you want to challenge it off and skip it off, your choice. But trust me, I think the 8 case laws really look nice and interesting, which you should be able to remember for exam. Just on the day before exam, if you can just make a small notes like this and you can take it for your exam days, I think it should already help you solve the paper off. And if you're able to score 4 to 6 marks from this case law itself, that is already a bonus for you. Yes, so please keep the judicial updates on priority along with your amendments which we discussed in the previous videos of statutory updates. If you can do that much, you're already through with your examinations. Clear? Yes, perfect. With this, we're done with the judicial updates also, people. Last thing which I have on my plate is to give you the section wise index, and with that we'll be done with all materials which is required for your CA final examinations of Jan 2026. After this, people, if you have any other doubts, any other clarifications, any support from my side for me to shoot out some videos and give it across to you, please drop it in the comment section and let me know. If you have any friends who are writing CA final examinations, and if you think this video was useful, forward it off to them, people, so that we can grow our community together and everyone together can pass off your CA final examinations. I'm really looking forward for you all to become a chartered accountant. So yes, we are at October. Last 3 months for your preparation time, people. If you can struggle a little bit for the last 3 months, the benefit after January is going to be immense on this. So please make your efforts in the last 3 months and give it through, people. No doubts, no challenges at this point of time. Don't self-doubt yourself. For the next 3 months, it doesn't matter what is going to happen in life. You only have one priority, that is to study, study and study. Yes, on that thought is what I will leave you for today. Let me come back very quickly with giving you the section wise index as well. Until then, keep reading. Take care. Bye bye.